You're listening to Don't Waste Water.
If you go in as investor, you have to understand what your exit plan is. Before you go in, always make sure you understand how you get out of it.
Hello, bonjour, and welcome to the Don't Waste Water podcast.
We bought a company in Turkey a couple of years ago, and it took me 7 years to convince the family to come to us. And in another case, we worked 10 years on a deal in the US.
I'm your host, Antoine Walter, and in today's episode, I'm delighted to welcome Mads Joergensen as my guest.
The last 2 decades I worked in this industry, there has always been a week where I get to know another company. I never heard about the company before, right? Because it's so hyper fragmented. It's really interesting how fragmented it is. And what we would ideally do is actually to do a series of, let's say, mid-sized acquisitions. So about ideally 75 to 125 million would be really sort of a sweet spot of stuff you can really quickly buy, quickly finance, quickly integrate.
Matt is Chief Financial Officer at Georg Fischer.
Do I need to be an investor in this company? Do I want to have a position as a commercial partner for this company? And that's what we're looking at. We love to cooperate with smaller companies, but we do not always have to be the investor into that company necessarily.
GF is an international industrial corporation with its headquarters in Schaffhausen, Switzerland.
The water sector and the focus on it is not solely on returns. I mean, if you want to make quick bucks, right, why don't you buy NVIDIA? If you want to make quick bucks, don't buy water.
What I just read you is the description you'll still find on Georg Fischer's website, yet with what just happened over the past 2 weeks, I would bet it's about to change. Until the end of October, GF was living the peaceful life of a 222-year-old company built upon its 4 divisions: casting solutions, machining solutions, building flow solutions, and piping systems. But that was until last week's big bang. The company that, full disclosure, happens to be my employer when I'm not sitting behind my podcast microphone, divested its machining solutions arm for about 650 million Swiss francs to United Grinding Group and evaluated strategic options to do the same with its casting solutions division. Said differently, GF fully embraced its new trajectory, becoming a water and flow solutions company with, on top of this, the ambition to become the world leader at that, starting from number 2. This move comes at a time when many people in the water sector speak of an inflection point, when water risk, water scarcity, and water management in the age of climate change seem to forcefully move the needle of an otherwise pretty calm industry. And with this move, GF is the latest player to shoot, but not the only one. We've seen DuPont splitting in 3, or Danaher spinning off its water business with Veralto, just to name the 2 most recent examples. What this shows, and it should be exciting for all of us, is that water probably never was as attractive as a vertical as it is today. In a paper I'll link you in the show notes, JP Morgan highlights how water is central in supporting around 60% of global GDP, and hence moves from being a former afterthought to becoming a bottleneck in far too many places and applications. And GF's reaction to that is just one more proof that the landscape adapts accordingly. As I'll discuss with Matt in a second, this is not only a divestment and a focus, it's also about building dry powder to achieve in years what would have taken decades. Remember when Global Water Intelligence and XPV showed last year how the capital employed in water security related assets would rise from $3.8 trillion today to $12.6 trillion within the next 10 years, and how that may result in the total value of water solutions and technology companies to increase from $290 billion to $1.4 trillion over that same period. What a time to be a water company, right? Well, I thought you'd be interested in getting into the strategic thinking behind a major shift for a listed company with a 4 billion yearly revenue that's willing to cut 25% of that off in thinking that that's the best way to get to 5 billion by the end of the decade. Lots of number, sorry, but Mads was kind enough to hop on an impromptu call, so buckle up and I'll meet you on the other side. Hi Mads, welcome to the show.
Hey Antoine, thank you for inviting me.
Do you have the power to fire me on the spot?
No, I don't have a license to kill.
Then I can go with more questions. Last week, GF announced a strategic shift with the company, namely becoming a water company. Can you just take me through the steps, which maybe, if I'm right, started roughly 1 year ago with the acquisition of Uponor.
Well, actually, Antoine, it started in 1864, I would say, when we launched the first water project, the manufacturing of malleable iron fittings in Austria. We still actually manufacture that product in the same location. But in the last 222 years, we've been doing all sorts of stuff. However, since maybe 2 decades, the corporation started to develop more in piping systems. And then, of course, the water relation is very close. When I joined the company in 2003, the piping systems was between 700 and 800 million in sales. And over the many years, we grew that based on a strategy of resilience. But what was really the transformation, the trigger for the decision to discontinue businesses that we have had for 120, 30 years was that we were able to come together with Uponor, the number one in hydronic floor heatings, as well as hot and cold water in the US and in Europe for PEX solutions. That was the big start of a consideration to focus on water and flow solutions.
So if we rewind to November 2023, when you acquire Uponor for about 2 billion, is the decision at that time already taken to focus on water and hence Uponor is a vehicle for that? Or do you bolt that company on and then you realize that, 50% of your business is in water, so maybe it's a good opportunity to even zero in even further on that specific topic?
I mean, Uponor was not an accident. It is a company that I've been tracking for 20 years. I started actually out in piping systems in 2003. I was in charge of strategy and M&A, and Uponor was on the list of, I call it, usual suspects in that area. And we've been tracking the company for a very, very long time. The project actually started back in 2021 when we reached out to Uponor, the Paasikivi family, and then first contact in 2022, and then extended negotiations on and off. We basically put the project on hold at the end of 2022, and then it was restarted with this unsolicited offer that came from Aliaxis. It's a long process in terms of getting to the acquisition. And for the strategy review, your question, when did it start? Well, they actually started around about the time when we were safe and secure that we were going to be the owner of this company. In the past, the businesses that we had together were self-contained in terms of investments. They can finance their own growth. We are now number 2 in piping worldwide. Number 1 is Aliaxis by margin of about 1 billion in terms of size. To really become number 1, let's say stretch target 5 billion in sales, we cannot do that with the current financing structure. We invested more than 2 billion debt financed to buy this company. So we needed to basically have a strengthening of our balance sheet, which we could either decide to do over a decade, 10 years, or we could do it really quick. So that was the trigger. We wanted to focus our cash flow so that we can actually quickly implement our growth ambition.
You mentioned balance sheets, and I'm going to be out of water there because you're a CFO, I'm a water engineer, but I'm going to try my luck still. The Uponor acquisition was 350 million in GF cash and the rest in debt. So now, I'm trying to project that on my own personal finances. When I see that you're selling an arm of the company for 650 million and you have another part of the company up for sales, I'm figuring out you're trying to rebuild a trésor, which will eventually be used for new moves we might discuss later on. Is that somewhat right, or is it much more complex?
It's very close, except for those funds that would come from the divestment of Machining Solutions would briefly touch my trésor, as you said, and then it goes back to the banks as a repayment of the debt financing we took up. We're getting a lower debt level that we have at the moment. Our net debt, so to speak, at corporate level by mid-year was 2 billion and 50 million. Net debt, meaning all the cash I have in the bank minus the liabilities. We want to get that number down as far as we can, only with the purpose of going back up again to finance future acquisitions in water flow.
So the move to focus on water, if we look at the macro world, sounds very timely, as you're not the only corporate doing that. DuPont is splitting in 3 and separating its water arm. Danaher has split out Veralto last year, and there are regular rumors of other conglomerates which are in various areas which say the water arm is special. With all the positive and the negatives, it has to be special, and we should take that as a specific. So it goes along the industry. My question is, if we look at what DuPont did, is they didn't sell out the water arm, they split in 3. The water company starts with more or less a new balance sheet, but it's still part of the conglomerate. Was it something you've thought of, or was it really not applicable to GF's situation?
We considered various ways of structuring this freeing and focus. There are many ways of doing this technically from a financial point of view. What we said, we looked at the core of Georg Fischer. This is a 222-year-old company. It's among the 40 oldest yet existing companies in Switzerland. Our job is basically, as the executive management, together with the board of directors, to set up old Georg Fischer for the future. Historically, the number of businesses we have been in is really incredible over the last 225 years. And they have changed. The executive management always had to find what is the next interesting business. For us, having already been in the water, it became a core competence. It was most of the sales. It was the vast majority of the profit. And we are known in many areas of the water industry as a household name. So it was a logic for us to focus on core competences and still have a solid, strong core called Georg Fischer.
How do you sell a 650 million business?
There is not one recipe to that. There's something peculiar about the situation is that we actually kept it confidential for a very long time. And the main reason for keeping it confidential was of commercial reasons, because we were in discussions and negotiations with some of the automotive customers. If you have a very important supplier, Georg Fischer, your customer, and you suddenly don't know where that is going to end up, you are very cautious and you would hold any important discussion. So
let's focus on the water part. I did stupid maths, and you helped me a bit earlier in that conversation by saying that GF is now the number 2 in that field, and looking 1 billion ahead, the number 1 Aliaxis. If I take the first half of the year and I multiply the first half of the year by 2, which has its approximations inside but gives us a sense of what we're discussing, the GF Flow and Solution arm, consisting of piping systems and Uponor, is about a 3.1 billion Swiss franc company. Your target by 2030 is to reach 5 billion with this, which would make for an 8.3% compound annual growth rate. How do you intend to roll it out in concrete steps?
This is, of course, not stupid math. It's actually pretty correct. And it looks very, very ambitious. Probably the water market, and there are many sources of what is actually the underlying growth of the water market. But if you take some of the big water conglomerates, or Xylem and Veolia and Suez, etc., they're probably looking at a market growth underlying of 2 to 3%. Where does the rest come from? We would, of the 8 probably CAGR, we would look at generating half of that, maybe a little more, from organic growth. And we have demonstrated that. If you look back 10 years for the legacy piping systems, or you look 10 years back for Uponor, who we acquired, compounded annual growth rate organically is 4 to 5, maybe even 6. So we've demonstrated that in the past, and there is no change in the industry that should actually make us deviate from that. The remaining bit is going to come from inorganic growth. Basically, we intend to buy further players and invest in this area and acquire companies around the world that have synergies with us.
You mentioned benchmarks like Xylem, Suez, Veolia. I just looked at some numbers because Veolia just shared their ambition, and they say
we estimate the size of the market is a bit more than 200 billion, growing 2 to 3% a year. We aim at growing 3 times faster than this market. This is 6 to 10% growth per year.
With 8, you would be in the middle of that. SOAR, the other French, which is maybe the most aggressive in terms of inorganic growth, is eyeing at 11.3. Grundfos, which is a bit more on the organic, is at 4. So somewhat in the same line of what you're saying with the organic of GF. Yeah. Xylem 4 to 6, Penter mid-single digit. So I would say with an 8% target, it sounds like GF is in the upper average of that pack. Is it because you're seeing the same shifts in the market as they see and you want to follow on, or do you have a specific strategy which caters to piping companies?
If you really compare apples to apples and peers to peers, the organic growth target would be then around 4 to 5%, and we demonstrated that. The uncertain factor in that number that you calculated is how much we're actually going to implement in terms of inorganic growth, the 4%, and that may not come every year consistently. I don't know whether you can remember when the ketchup was actually in a glass bottle and you had to wait for it to come out, and then it came all at once, right? It's called the ketchup effect, and M&A deals very often comes in tsunamis or come very quickly. That's why we waited quite a long time before we could do the deal, but we clearly overachieved our 2025 inorganic growth target by acquiring Uponor. So it's possible. It's possible to buy something in this industry.
I guess you can't answer that question, but I need to ask it nevertheless. Do you have something in the fridge which is worked on right now and would be under due diligence and would be announced in 2025?
The last one I cannot guarantee you. And the reason is basically the companies that we're talking to are family-owned. The process of a family to decide to sell their business, there's a lot of constellations and stars that has to be right. But one of them is it's important for them, where does that company end up? Some of these families are in the business for a very long time. Their personal relationship with the employees, the company is named after the founder, and all these things are important factors that we discuss with them basically. And therefore it takes a long time. Just to give you a couple of examples, we bought a company in Turkey a couple of years ago, and it took me 7 years to convince the family to come to us. And in another case, we worked 10 years on a deal in the US before we came together. So you need to have a portfolio of these very long-term projects, and the portfolio has to be big enough for us to be able to come to a realistic closing of a deal at one point in time. So we are working on these various opportunities, and they are in different stages of progression, I would say. I'm not going to promise you a deal in 2025. Actually, I'm never going to put a date on it because it's bad omen.
But what I understand is that really there is a deal flow and that you have strong prospects.
We're scanning the market. Our M&A team is extensively working with many other external parties, banks, advisors. It may be surprising to you, but actually the last 2 decades I worked in this industry, there has always been a week where I get to know another company. I've never heard about the company before, right? Because it's so hyper fragmented. It's really interesting how fragmented it is, which also should give you a relatively high likeliness that we are able to close something. And what we would ideally do is actually to do a series of, let's say, mid-sized acquisitions. So about ideally 75 to 125 million would be really sort of a sweet spot of stuff you can really quickly buy, quickly finance, quickly integrate.
You mentioned the fragmentation, and I think it was part of the investor call you had with Andreas Müller. He said, for me to quote his words, GF will capitalize on a fragmented competitive landscape with further potential for consolidation. When I hear that, that means you're looking at horizontal expansion, because one would think now that you're a water company, you might also go vertical. So is it really horizontal and that's it, or do you maybe combine the 2 dimensions?
My very quick answer to that question is it depends. It depends on which market and which opportunity you're looking at. Nevertheless, we would tend still to focus on manufacture of components, systems, but also on the softer side and digital software side. But manufacturing companies, maybe service companies, engineering companies can support our growth as well. And then there may be a few markets that are in a different structure. Let's take maybe a Southeast Asian country where the distribution structure is very different in the piping industry than it is in Western Europe. Maybe there it makes sense to go downstream and also own a part of the channel to make sure that you are much more present in the market. We don't do that in Western Europe. We are an established brand. The industries in certain countries very consolidated. So it really depends on which country you're looking at. But we would in general not do much upstream or downstream integration. It's more horizontal consolidation move that we want to do.
Horizontal consolidation with the target to become the number 1 water and flow solution provider by 2030. Number 1 sounds cool, but beyond sounding cool, why that target?
There's one of the, let's say, the unwritten laws. When companies get over a certain size, it gets into a growth acceleration. When they get to a certain level, it's above 4 for sure, but close to 5, then there seems very often to be an acceleration. You get a critical mass in the company that makes it even more resilient. And also because in the industry, the piping industry, there is more economies of scope. There is economies of scale. If you have a piping company, and if you look at companies like Alberts, Aliaxis, and many other players in the industry, they've actually created sort of a water or piping systems platform on which they're loading up, they're doing serial acquisitions, and that creates a own dynamic in terms of growth. In this case, you can say size matters, and there is like a magic number in terms of the 5 billion.
You're bringing the name of Aliaxis, so I'm going to just use that as a follow-up here. Aliaxis also has a specificity in the way they invest, which is a bit different from what GF does, if I'm right, which is they have this venture arm, which looks into smaller size companies and puts some tickets in those smaller size companies. You've highlighted how your target is to aim for 50 to 200 or 75 to 200 million companies. So that's a different type of companies, and probably not by taking a ticket, but by making a full acquisition. Would you envision a future where maybe you do a bit of what Alexis and others do and go into that venture part?
It's a very good question. At the moment, it's not a strategy we have pursued. I will not completely rule it out in the future. Honestly, Antoine. There are companies that do it successfully. It is, however, something that you really have to ask yourself, am I big enough to do this? You can see that companies like the big pharmaceutical companies, they typically do this kind of or biotech companies, they invest into startups, and maybe they get a lucky punch and have the new future drug that is developed outside of their perimeter fence. But for a water company, our industry is less innovative. It's just inherent in the industry when you deal with water that you don't see big shifts in innovation. It takes a long time. We can do another podcast on why it is like that. But innovation is somehow a hygiene factor. You have to have a basic innovation to be in the industry at all. But is it the driver of the top line? We're questioning whether really the innovation and providing new technology and looking at how challenging it is for our customers to pick up some of the fantastic products we develop. That's why I'm a little bit reluctant, and I would like to at least continue to observe what's going on.
The next episode of my podcast is going to be about that book, The Dynamics of Water Innovation. I had an interview with the author of the book several years ago, and we had several updates in between to confirm what you were saying about the timelines. It takes about 35 years for a water technology from its very beginning of research until the moment it's in the middle of the market. So for sure, if you want to take innovation as your vehicle to be a 5 billion company, it's not straightforward, but it's building the pipe. You want to make bolt-on acquisitions, which will have a direct impact on the company's top line and then on the synergy and then reaching that strategic scale, which might be 4 or 5 billion, and then the growth is going to be easier. But there's also an element of knowing how to work with those smaller, agile players in a time when water scarcity, emerging contaminants, new stresses and new risks for industries based on water seem to be changing a bit the name of the game.
It's a very good point. And there we see ourselves maybe as a catalyst because we got this nice platform in the water industry. But sometimes when you're in VC, you have to really ask yourself, do I need to be an investor in this company? Or do I want to have a position as a commercial partner for this company? And that's what we're looking at. We love to cooperate with smaller companies, but we do not always have to be the investor into that company necessarily. And there are many different ways of doing business with them. Either you buy the products off the shelf, you can do white labeling, you can do joint development. We were in discussions with a company that was working in the oil and gas industry, and some of the products that they had could actually be used in the water industry, but they needed conversion and development as such. It was a startup, and we started basically to develop a separate business case for them. And then we entered into an exclusivity contract. So can we, for water applications, we want to be the sole business partner for the area. You can continue oil and gas, but we see some water opportunities. We see those as business opportunities necessarily more than we see it as an investment opportunity. And if you are in venture capital, you may end up in a conflict with co-investors. So I'm a water company. I invest in a water startup together with many other people who only have one single objective, that is the financial return. And I come to the point that I actually want to own this company. And the co-investor says, no, we're going to go for an IPO with this, right? And I need this technology. You really have to make sure that if you go in as investor, you have to understand what your exit plan is. Before you go in, always make sure you understand how you get out of it. And I'm sure Alexis are doing these considerations before they go in. But we see our role more from a commercial point of view in startups.
I have one last follow-up here, and then I'll leave you with that topic and we move to something else, I promise. I'm obsessed, but not obsessed to the point that I will annoy you. Let me give you another example, which is Xylem. What Xylem does is not investing in company. They have their specific arm called Xylem Innovation Labs, where they do partnerships with startup with no equity, but they are going to co-market. So if I understand you right, that's a bit more the approach you want to follow.
It's working with entrepreneurs and business owners on developing their business with the benefit for us. basically. That's the approach we wanna take to it.
So financially speaking, the move of GF to focus on water has been very welcomed by the markets. It evened up in the week, but the day you announced it, you got a 15% jump in share value. I guess you're the CFO of a listed company. That has to be a driver, right?
Share prices come back a little bit since then, but it's a natural process because it's a financial market. People don't necessarily own their Georg Fischer shares out of passion, but out of expected financial return. And if we had this big jump, I'm sure that in the coming weeks there will be some settlement. People decide to take some profits in rather than stay as part of the story. But in the long term, we will probably be in a good trajectory.
From a company structure perspective, you had 4 arms within GF. Now you're deciding to spin out 2 of them or to sell out 2 of them. What do you do with the 2 remaining? Do you keep them separate or do you bring them together? And the title of your PR was GF Water and Flow Solutions. Is that a hint to the future of the company?
How we organize ourselves internally has not been definitely decided yet. What we sure can say is that from a business area point of view, the way we will talk to customers and to investors actually and stakeholders is we have 3 flow solutions areas. One building flow solutions, an industry flow solution, and an infrastructure flow solutions. This is a portfolio of businesses that we have had also for many, many, many years. When I actually joined the piping systems part, we had these 3 areas. Now they're lifted up at the corporate level and they will be used as explaining what Georg Fischer is about. What are you investing in? You're investing in a portfolio consisting of these 3 flow solutions related businesses. Looking at them over time, I'm talking decades, over time, these 3 areas actually surprisingly bring more or less on average the same growth potential as well as the same profitability level. But it shifts over time. At the moment, we are overweight on the building flow solutions through the acquisition. Industry has grown extremely strong because of the regionalization and deglobalization of our regions. And infrastructure, which used to be starting from 2000 to 2010 at least, was a very strong growth driver. Now is taking a little bit of a backseat situation, but this will shift again in the future. And that is the strength of piping systems. We have a much more resilient portfolio because we are in all these business areas and we are around the world. We're not just in Europe or the US. We got a pretty good balance, I would say, in the world. And after we have exited these 2 businesses and really refocusing on flow solutions, we'll probably be about 30% in the US, roughly 45% in Europe, and roughly 20 to 25% in Asia.
Last year, XPV and Global Water Intelligence published a paper together on their bets of how the total market for water was moving, and they predicted what they called a $14 trillion opportunity. A big chunk of that being the fact that water risk is becoming super pregnant for industrial players. So their big bet was that out of the 3 verticals you just listed, the one which is going to be booming in the next decade is industrial. So that to me is pretty logical. On the infrastructure part, nevertheless, everybody agrees that there is a deficit and that the infrastructure is crumbling a bit everywhere around the world, but the investments have yet to come. So what makes you optimistic that the States and the world will realize that at some point they will need to pour, in the US it's 400 billion, which they have as backlog in terms of the infrastructure.
Maybe back to your first statement about industry being the most attractive opportunity. There, I must say, we find the 3 areas equally attractive because there are fundamental drivers that are very strong in those areas. The energy efficiency in buildings, the incredible need for renovation in Europe to be able to achieve the CO2 reductions and the net zero targets set by the EU. You got on the infrastructure side, the drive for urbanization. We still have growing cities. Just look at Switzerland. When I came here, it was a 7 million, right? Now we are past a 9 million population and the country didn't get bigger in the meantime, right? And this is very anecdotal, but on a global scale, there is no reversal in this trend in terms of urbanization requirements for infrastructure. Why are we not seeing necessarily a NVIDIA exponential growth in infrastructure? There are many factors, but here's one hypothesis. Putting stuff in the ground, like pipe, doesn't get you elected as a mayor, as a president, whatever. It doesn't necessarily. But we've seen in the past that if the pressure, the climate situation and the pressure from the consumer, from the population on drinking water, as it happened, for instance, in Sao Paulo, when those constellations come together, then it becomes a political topic and the funds are released to invest. So that's why SABESP, which is the water authority in Sao Paulo, decided really we need to completely renew our water network. And those constellations, they always come together very situatively. So it happens around the world. And my expectation is it will probably remain like that because of the things I described before. We never sold any of the piping or the flow solutions businesses as an exponential business, but it will give you very solid mid-digit growth rates over the coming decades.
I have no stakes in this book, so I'm not just pushing it for the sake of pushing it, but it's what they define as crisis driven. And they show how when there's a crisis, basically adoption goes twice faster. And unfortunately, you're right, you need to see a day zero to start investing in your infrastructure. One would hope that it's not the case, but you need to hit the bottom to come back.
That is correct. I mean, we just to give you another interesting, we went to Mexico City, right? Mexico City has depleted water resources and they have to get it into the valley. So they're actually pumping enormous resources of water into a city, and they're probably losing maybe 40 to 50 to 60% of that water in the process because of leaking pipes and the depleted infrastructure. And the energy that they need to get this done, right, takes the same amount of energy as if you take all photovoltaic installations in Germany all together. That's the energy you need to pump that water into Mexico City. And still, there is no massive drive in the city to renew all these networks and improve it. We can just wait until these constellations, let's say, come together, and then you have the perfect situation, and then there will be funds released to invest. But at the moment, everybody are just living the way and finding intermediate solution to the fundamental water problem.
So that sounds like the big bet you do on infrastructure, which has its rationale. What would be your big bets on the building flow solutions?
Two things. We are strong in the US, and the US is a growing country. The underlying drivers in the US, population growth, etc., renewing the aging real estate, they build differently than we do in Europe. As you know, the resilience of some of these buildings is not the same thing. So we would say that the big bet is a continuation of the US market. The underlying drivers are there. On the product development side, we need to make sure that we continue to make the simplest and easiest and best installation system with absolutely zero risk for any water damage. The big bet in the industrial area, that's a different animal, right? So the sales process for an industry, it's engineering driven. It is performance driven, so the system has to perform better than it was before, or the solution, which is the alternative. But what is the great advantage of it? If you become a household name somewhere, as we are in microelectronics, or let's say applications on cruise ships, once the engineers have specified you, they have very little incentive to change it. So our bet in that area is to focus on niche applications or market segment that we basically own, and then get annuity returns in our business.
I usually have, when I'm talking with a water scale-up, which is more of my demographics on that microphone, this rapid fire question at the end where I'm asking them if they go for profitability or growth. And I don't let them explain. They just have to give me profitability or growth. You'll have a special treatment here because you'll have the ability to explain. You have a target of 5 billion by 2030. There are different ways to go to that. You might have to compromise on profitability in order to achieve the growth. As a CFO, those are two levers which might be difficult for you to play on. If you have to pick one, what would you pick if they can't be fully synergistic, profitability or growth?
In the short term, for us, it's about profitability, because the profitability shows the quality of the company that we have. As you've probably seen announced by mid-year, and also our update to our guidance for the year, after two absolute peak and top performance years, 2022, 2023. This year we have a slightly lower profitability. And post, let's say, focusing on water and flow solutions, we want to consolidate, regroup, and work on our profitability in the first phase. And then at one point in time, it shifts. If you reach a certain level, actually empirically, it's a return on invested capital above 20%. Empirically, it shows that once you've reached that, then you should focus on growth. Your value added is higher higher by adding incremental growth than is that optimizing the return on invested capital margin as such.
I see that you have strong benchmarks as to what you want to reach in terms of size to get the scale effect, in terms of return on investment capital to get the lever effect there as well. So again, as a finance muggle, it's pretty impressive. Usually I'm rounding off those conversations with rapid fire questions. I'm not sure the entire list would suit you, but I have one specific rapid fire question, which I'm looking forward to your answer. What's the drop of knowledge you wish more investors knew about the water sector?
How incredibly important it is to human life.
But that is a qualitative answer.
Yes.
Investors, I'm told, are cold-hearted animals which want to make money. Am I fully wrong with that?
Of course not, but I cannot rule out that the water sector and the focus on it is not solidly on returns. I mean, if you want to make quick bucks, why don't you buy Nvidia? If you want to make quick bucks, don't buy water. If you look at the performance of many water funds, you have to have a touch of, let's say, sustainability. It has to be on your agenda. There is a fundamental element of sustainability when you talk water. That's why the investors we have or want to attract are those who have that topic on their agenda.
JP Morgan just released a position paper on the water finance ecosystem and saying how they believe actually exactly what you said about the water infrastructure and how all of that sounds like a good investment thesis. I'll link the paper in the comments because I don't want to butcher what they said. They have interviewed me in the process, so I'm a bit biased in how good I think their conclusions are. But to me, that's a shift that this kind of finance profile are looking at the water sector. They really were out of the picture just 5 or 10 years ago. In your own investor discussions, in your own financial behind the scenes, do you also see that increased interest and hence your move sounds even more timely? Or is it a surface thing which I'm getting enthusiastic, but it doesn't have like real background to it?
I must say, if I really look at it from a global perspective, there is a heightened interest in it. When Biden announced these packages now a couple of years back, it was the first time he actually earmarked investments for the water sector. EU has done the same. I think even China. There has been infrastructure investments in the past. Barack Obama was running programs, but nobody really earmarked water. So I think it's moving up on the agenda. You're not going to see leaps like AI. No, but I think it's going to be moving steady up. And also because we have these increasing problems around the world. I mean, not far from here, get in the fly 2 hours and you have a huge environmental problem in Spain. Right? It's solvable, not from a fundamental, but we could surely patch it up with some stormwater management systems and that whole area, right? So we're definitely willing to help working on solutions for mitigating these climate changes.
Matt, as a conclusion, when would it be fair to judge the effects of your new strategy? By when should we have a sequel conversation to say, hey, it worked or it didn't work?
We actually define our strategy by 5-year periods, and we are still in 2024. Technically, I still have another year, but we don't look at it like that. We have a new situation. Let me answer that question differently. I think give us a bit of time, and we will, in 2025, come out with a revised, focused strategy with some aspirational targets, and then we can talk about what is the right time for me to come in your podcast again and see where we are.
So I'm still not fired.
No, Antoine, you have to push me further than that.
Don't tempt me. Well, Mads, thanks a lot. And I wish to have a sequel when you have that strategy to share with the world, because now that you're a water company, fully, you have an open seat on that microphone whenever you want.
Antoine, I'm looking forward to the next podcast. Thank you.
Thanks for listening to Don't Waste Water. This podcast was brought to you by GF Piping Systems. Loved this episode? Head over to Apple Podcasts to subscribe, rate, and leave a review. See you next time.